Hi everyone, welcome to another update on the Stock Screener. Today we're going to talk about some oil field services, as someone wanted to know about these companies. So I picked 4 companies: Trican Well Services. This one hasn't performed well, so it's flat, actually down, so very bad. STEP Energy Services has gone up more than a double, so this is a very good performer. Cathedral Energy Services has gone up, not a lot, 40%, but that's also a good performer. Ensign Energy Services, yeah, also a good performer, but lately it's a bit flat. So let's take a look at the metrics. Before I get to the metrics, I should talk a bit about oil well drillers. So basically you have Canadian drillers and US drillers. We all know that US drillers are in terminal decline because there is not a lot of area there to drill. So I think that these US drillers will underperform. You can also already see that the amount of rigs have been going down lately. So it peaked here, then it went down, and then even more down. So this shale boom is now going bust. So I think you should focus on Canada instead of USA because the shale boom is over. And otherwise, we also know that the oil rig productivity is down, which is actually positive because that means that you need more drilling to get the same amount of production. So that's a positive. But when we look at Canada, Canada is growing production. So I think Canada will outperform the US. And here you can see that the amount of rig counts is going up. This is a total one. It made a new high. So not bad. Here you can see that demand will keep on increasing. Well, not that fast anymore in 2023 and 2024, but utilization rates will keep on rising because there's limited supply available of drillers. So the rates will rise and demand will also rise a bit. In the US, the same. Demand will rise and utilization will rise. But I would focus on Canada because this is a faster growing industry than the US. So let's take a look at the first one, STEP Energy Services. 300 million market cap. Third quarter net income was 30 million. So that gives a PE of 2.7, right? So price divided by the net income and for the whole year. So that gives us a PE of 2.7, which is actually very good. Very cheap company. I want to buy this. PE of 3. The net debt was 150 million. So debt to equity is 50% with the equity at 300 million. So there's quite a bit of debt, but it's not like it's 100%. So they can probably pay that off in, let's say, 2 years, less than 2 years. So that's not a concern. Then we have annual EBITDA at 200 with capex at 100. So that's about 50% is capex. So free cash flow is 100 million. Price to free cash flow is 3.4. So this is one of the lowest valuations of the four. So you can already see that STEP Energy Services is the best one. Price to book also very low, 1.2, 3.4. Let's take a look at the gross margins, 20%. Yeah, this is not that good. The lowest gross margins, one of the lower operating margins, but net margins, you can see that it's 12%. So net margins are higher than the other ones. Not sure why, but it's higher. So if I were to choose one of these four, it would be STEP Energy Services. The next one is Trican Well Services. So this is double the size of STEP. Net income is 38, so that's almost the same as STEP Energy. So the PE ratio is double. So 5 PE. I think this one is overvalued. Also, the price to book is higher. The price to free cash flow, this is a value trap. 12. Why is this so high? That's because we have an EBITDA of 170 million, but a very high capex of 100 million. So more than 50%. So the free cash flow is actually lower than STEP. And that gives us a price to free cash flow of 12. So Trican, why is it down? Because it's a value trap. So please don't buy this one. Gross margins are good, operating margins are good, net margins are also good, and this is full Canada. So yeah, there's no debt. This company has no debt. It's actually working capital positive. So there's no financial leverage on this one. It's a very safe margin play, but overvalued. You can see that here. PE of 5, price to free cash flow over 10. So not a lot of upside, but it's a safe play. Very safe. Not safe on valuation, but safe on earnings perspective. But I wouldn't touch this one because it's overvalued. The next one is Cathedral Energy Services. Almost the same as STEP, a bit smaller, but the net income was not that good. 8 million in the third quarter. So PE ratio much higher than STEP. Price to free cash flow is about the same. It's 150 and then free cash flow of 60. Debt to equity is about the same, also around 50%. Margins also the same, but net margin is a bit smaller. This one, yeah, also has USA. So Cathedral is about the same as STEP, I would say, but price to book is higher, and also price to free cash flow is higher, and the PE ratio is higher. So about the same, but STEP is cheaper and is also a bigger company. So I would still stick to STEP. So STEP will probably go up, and Cathedral will also go up, but not that fast. Then the last one, Ensign Energy Services, is one of the bigger ones. The same as Trican, but net income is much lower. Only 18 million in Q3. And here, look at the debt. The debt is 1.5 billion. This is a high-risk company. Debt to equity higher than 100%, with equity at 1.2. So price to book value is actually lower than 1, half price to book value. So the market doesn't give a lot of value to this company because it is high risk with a lot of debt. Free cash flow, yeah, it's just 50% of the capex is 50% of EBITDA. So price to free cash flow is okay. 4. PE ratio is too high at 10. Gross margins are good. Operating margins not that good, but look at the net margins, only 4%. That's because of the high debt and finance costs. So not good. So if costs keep on rising, labor costs go up, then this could actually quickly go negative in earnings. And here also it's 56% USA and only 28% Canada. So it's in the wrong market. It's in those shale plays that are declining in acreage. So there will be less drilling for those shale plays because they are going bust. So that's not a growth market. Avoid this one. Ensign Energy Services, too much debt in the wrong markets, low margins, too high PE. So let's see. Yeah, this is not doing well, and this is actually has gone down a bit from April. Will probably go down more due to the debt, and a lot can go wrong with this company. Look at the earnings, it's almost at 0. So yeah, it's not making any money. So avoid Ensign Energy Services. So I would just stick with STEP Energy Services. Actually, even want to buy some because it's a very low PE ratio. And yeah, that was the update. Just giving some examples and ideas. So do your due diligence and pick one. I'll see you in the next video. Bye.